Still on the accounting concepts and conventions, we'd like to look at three of the accounting concepts and conventions in this video. The first one is the matching concept, the principle that underlies the determination of profit. So which means that if you want to determine your profit from the basic mathematics, it is your selling price minus your cost price. It is the same application in business. So in business, if you want to determine your profit, it is your revenue for the year, then you set it against the cost or expenses for the year. That principle underlining the determination of profit, which ensures that our revenues for a particular year is set against the cost or expenses for that particular year, is the matching concept. The matching concept basically says that revenue for the year should be set against the cost or expenses for the same year in order to determine our profit. We then go to the next accounting concept, which is the accrual concept. So the accrual concept is similar to the matching concept to the point that people mostly call the concept accrual or matching concept. But then these are two separate or different accounting concepts. So the accrual concept is saying that we should match revenue against expenses. With the accrual concept, we are saying that the revenue that we are matching or setting against the expenses, it should be revenue whether received or not, and expenses whether paid or not. So your revenue should not only be the revenues that you have received in a form of cash, but then your sales or your revenues which you didn't get in a form of cash and they are on credit should also be added to your cash revenue or your cash sales. And then we set it against all the expenses that we have paid for and the ones that we couldn't pay for. So the accrual concept is saying that revenue for the period, whether received or not, should be set against expenses, whether paid or not. And that is the accrual concept. In accounting, when we make reference, it has different terms. It's the same as owings, is the same as outstanding, is the same as arrears. Sometimes we call it due. That is the accrual concept. Okay, so let's go to the last one that I would like to talk about in this video, which is the periodicity concept. Financial statement are statements that the accountant will prepare. Okay, and we prepare financial statement within a particular period. And that period within which we prepare the financial statement is actually determined by a particular principle, and that principle or convention or concept is the periodicity concept, which says that the financial statement that we prepare should be prepared within a stipulated period. And in accounting, we use 1 year in preparing our financial statement, and or we prepare our financial statement within a year. Okay, so if you want to know the profit for 2016, it is whatever happened from January up to December 2016, making a year. And that is what we use to determine our profit for 2016. So the financial year or the accounting year is just 12 months. We call it the accounting year. With a periodicity concept, it means that we just have to prepare our statement within one specific or stipulated period. Okay, so that is all about the three basic accounting concepts I would like to address in this video. Thank you very much.